Good day, guys. Welcome to Trading Arbitrage Opportunities with Calvin Puts. The new account will be Forex Money. So, on the previous video, we talked about the US dollar, the economic side of the US dollar, and the US dollar having to move higher, not because of economic releases, but because the central banks are willing to push the market higher so that they expected the rumor that we're going to be buying the dollar in September are going to be, we're trying to price in the, we're trying to price in the, the sell that we're looking forward to. I'm not trying to be complicated, but that's that's just something that we will understand in the future. So it's not the recovery, it's just that we're going to be selling and you cannot continue to sell the dollar when it is already oversold. So the market might come back to the last order block here that we're going to be looking at. And the last bullish candle here that we're going to be looking at. But it would be, I'll be much happier if the market touches the trend level and moves higher. So we talked about the US dollar. Now it's time for us to talk about the CHF. Now, what's happening with the CHF is that even though the GDP is telling us that it has recovered, it has recovered. When the reason why the GDP recovers first before inflation is because when those interest rates are low, it is because uh, when interest rates are low, it is cheaper for when interest rates are. Let me show you the interest rates. When interest rates are low at 0%, it is it tells you that money is cheaper. Money is cheaper in the form of loans. When you go to the bank to make a loan, they will tell you that the interest rates are at 0%, meaning that when you take a loan, you're not going to be paying that much in interest. I don't know what they're going to be charging in interest, but I believe that I don't know how they do this thing, but the interest rates are at 0%. So paying back, you might be paying because of time. Because when you pay a loan over a long time, let's say it's over a period of 5 years, let's say you borrow 50,000 rands and you're going to be paying it over a period of 5 years. The person who pays over the period of 5 years and the person who pays over a period of 10 years, they won't be paying the same. The guy who's paying for 10 years will be paying more in interest because they're charging you for the time that it takes for you to finish to pay for that loan. And the guy who's paying back the loan for 3 years will pay less money compared to the guy who's paying for 5 years. So the interest rates are at 0%. That means every loan that you take will be for free. The only thing that you're going to be paying for is time. So these interest rate cuts are going to be continuing. The Swiss National Bank will be continuing to cut interest rates because the economy has not recovered. So the reason why the GDP is telling you that it is actually recovering, is in a bullish uh, direction. The reason why it is flying all the way to 2.8%, 3% is because the banks, is because the companies are doing well. They're getting loans for free. Okay, it's not for free because they're going to be paying for the time that they're going to pay back the loan. But because money is cheaper in Switzerland, the companies are doing well. That's why the GDP is going to be. I'm expecting the GDP to actually get to the 3.5%. I'm expecting it to go up here. Why? Because money is cheaper. However, the inflation here is telling you that it has not recovered. It was in the negatives and it just took on 0.2%. we have a long way to go. So if our inflation is going to be recovering, uh, we have a long way to go. We need to do something like this on this side. We need to get in a serious uptrend. So they might keep the interest rates on 0%. The reason why is because the inflation is responding to the interest rate cuts. So if they get into the negatives, they're going to be have issues that with the banks. You know, the banks are trying to borrow people money. They don't want to borrow people money for free. So the banks are going to have issues in their way of making money. So the government will have to supplement the banks with something because no one wants to, uh, you know, the reason why the banks are able to give away loans with negative interest is because the central bank will give money, will borrow the bank, will borrow money to the banks for for almost nothing. So the loans are going to be cheaper from the Central Bank of Switzerland for the banks to take loans. So because of that, the banks are also doing well in Switzerland. So here we have an unemployment rate that is telling us that it was in a downtrend and it's starting to recover. But at the moment, I'm expecting this unemployment rate to drop below this. Even though the businesses are doing well, I'm expecting the unemployment rate to drop below this because the economy has not recovered, and there's a high possibility that the Bank of Switzerland, if in case they get a tiny bit lower in inflation, they might be forced to cut interest rates. So, because of the expectation of negative interest rates, I have a belief, an economic, uh, my economic consensus is telling me that I need to, you know, to sell. Okay, the CHF, because of this recovery, at the moment we need to sell the CHF. The reason being that the reason why I'm talking about selling the CHF is because the CHF is also repositioning for a bull run. As you can see, the unemployment rate is telling me that the currency is recovering. So it was in a downtrend, now it's recovering. So because of that, I'm expecting to buy the CHF, but it won't be at the moment. It won't be now. I won't be buying it now because of this inflationary recovery. I'm not going to be buying it now. I'll be buying it later. But for now, I need to sell it because the banks are not willing to buy an expensive CHF. The CHF economically is oversold. So because it's oversold, the banks are forced to sell the CHF so that they can push it to a level where it is worth buying. Now, what am I buying in the CHF? Let me show you what I'm buying. I'm buying the recovery in the unemployment rate. People were, you know, I'm buying the recovery in the unemployment rate. So in the coming future, I'm going to be buying the CHF, but for now, I need to sell the CHF because the CHF cannot be sold when it cannot be bought at a higher price. So the CHF has to recover. Let me show you an example of what I'm talking about. Let me show you an example. Let's say we have a downtrend like this. At some point, the market cannot continue to drop like that. Somewhere we need to have some kind of a pullback. So the CHF is oversold economically, and we're expecting the okay. The CHF is overbought economically, so we're expecting to we're expecting the CHF. Let's say the CHF is oversold. We're expecting the CHF to give us a pullback economically. You know, talking about, here I'm talking about an inverse direction, because when I'm talking about oversold here, I'm talking about overbought, because the CHF, when the CHF is selling, is actually moving down in this. When the US dollar is buying, is moving up. When the CHF is buying, is moving down. So that's something that I had to address because it's confusing. So the CHF is overbought because it's moving down. We need a pullback in the CHF. Now the pullback will be that the CHF is selling, and after the selling, we need the CHF to buy again. So this is the economic report that I have. It's telling me to buy the CHF, but the CHF is oversold. So for us to be able to buy the CHF, it has to be at least at this level, or it should the market should be here for us to be able to buy the CHF. And that buy will be in September, and that buy will actually cement our third touch that we're talking about here. Third touch that will help us be able to, that will support our trade in the major bust that we're looking forward to in the economic recovery in the United States. So, what we are doing here is called hedge inflation. Let me show you what hedge inflation is. The economy in Switzerland is collapsing, it's not yet recovered, and the economy in the United States had already recovered. So, the inflation that we are hedging the inflation in Switzerland with the inflation in the US dollar. The US dollar is saying the US dollar's inflation has recovered. Let me show you the US dollar. I am running out of time. And okay, on the next video, I will tell you, I will explain what I mean by hedge inflation. This is the end of the video. And let's see, this is episode 18. Let's see each other on episode 20.